Welcome to this event of the Pembroke Speaker Series at Cambridge Judge. I would like to welcome all of you here in the room and also all of those following us online. And rest assured that we're going to be keeping track of whatever questions those of you who are attending online will be sending through the application. I am Mauro Guillén. I'm the Dean of Cambridge Judge Business School, and I'm delighted to introduce the third interview. This series is supposed to provide us with critical insight on a range of areas from academic and practitioners. On behalf of the school, I wish to express gratitude for the gift that makes this possible, as well as PhD scholarships and the Pembroke Visiting Professorship in International Finance. This relationship, this collaboration between Pembroke College and the Cambridge Judge Business School is ongoing in so many different ways, and it is central to the university's mission. I would like now to introduce our two speakers here today. I would like to ask you to welcome them with a very strong and warm round of applause. Is Lord Chris Smith, Master of Pembroke College, Cambridge, who will introduce our guest of honor and keynote speaker, Lord King of Loughborough.
Well, thank you very much, Mauro, for that really kind introduction. It gives me great pleasure to be hosting this moderated conversation today on behalf of Pembroke College, and huge thank you to the judge and to our donor who has made this event and many other things possible. A warm welcome to everyone in the audience today, both here in the lecture room and also joining us online. The interview will carry the title, Global Political Economy from the Financial Crisis to the Next Decade. And I'm very pleased that Lord King of Loughborough, Mervyn King, who served as Governor of the Bank of England from 2003 to 2013 through the financial crisis, is joining us. He had been Deputy Governor from 1998 to 2003, Chief Economist and Executive Director from 1991, and a Non-Executive Director of the bank from 1990. Lord King was knighted in 2011. He was made a Life Peer in 2013. He was appointed by the Queen as a Knight of the Garter in 2014. He is far more distinguished than I am. He's a Fellow of the British Academy, an Honorary Fellow of King's and St John's Colleges here in Cambridge. I'll forgive him those. He holds honorary degrees from a number of universities at home and abroad, including Cambridge. He's a graduate of King's College, Cambridge, had a first-class degree in economics, of course. He was then a Fellow of St John's College. He was a Kennedy Scholar at Harvard University. That's something I do share with him. He's also chair of the Philharmonia Orchestra and a member of the House of Lords Economic Affairs Committee. Welcome, Mervyn, to this interview and discussion.
Well, Chris, thank you. It's a real pleasure to be here, and I look forward to our conversation.
So, onward to the interview, and first and most obviously, what, Mervyn, do you think of the government's handling of the crises caused by the pandemic? Do you think the economic response from the Treasury in particular was the right one? Did they make the right decisions?
So I think the Treasury did make the right decisions. There are marginal things you could possibly disagree with, but broadly I think I'd start by trying to differentiate between the health response and the financial response through the Treasury. So when the pandemic hit, either through government lockdowns or because businesses and households themselves decided to stop going to work or not to spend on certain things, this was an extraordinary situation in which if the government had not stepped in, then many businesses would simply have just disappeared because their revenue collapsed, turnover went to zero. And so the government introduced the furlough scheme, and I think the furlough scheme was absolutely the right answer. It could have been slightly more generous towards self-employed people in the early days. It could have been linked directly to the progress of the pandemic in terms of an ending point. But to step in on such a massive scale to prevent businesses that many of which would have a viable future at some point in the future, to prevent those businesses failing in order to maintain employment was crucial, I think. And the contrast with the US is very interesting because both the US and the UK started in early 2020 with unemployment rates about 4%. In the US, unemployment went up to over 15%. It's come down quite sharply since, but it went up to over 15%. And ours hardly moved at all. And many economists were forecasting significantly higher unemployment rates as a result of the pandemic. The furlough scheme just stopped that, nipped it in the bud. So I think the furlough scheme was exactly the right thing to do, and the Treasury does deserve great credit for that.
And of course, in order to fund the furlough scheme, the Treasury was shoveling money out of the door. Mm-hmm. It has built up as a result a very substantial amount of debt. What should it do about that?
Well, they've got a plan for dealing with it, which is that starting 3 years from now, the ratio of national debt to national income should slowly but steadily start to come down. And I think that's exactly the right approach. The whole point of having a national debt is that you can expand it when something really bad or untoward happens, provided that in normal times you ensure that the ratio of debt to income is coming slowly down. And we don't expect that an event like this is going to occur, every other year. So I think it was reasonable to say we should be prepared to let national debt rise in order to transfer money essentially from taxpayers in the future, spread over a long period, to businesses today to prevent them failing. I think that was a perfectly sensible approach, and I don't think the amount of debt that was created was taking too big a risk. I think they had to do it. The key test now is whether we can get to a point where governments over the next 5 years will realise that the ease with which it was possible to raise public spending in the past 2 years will have to come to an end. It's not that they'll have to cut massively spending, but they need to get to a budgetary position in which, once we've really got clear of the immediate consequences of COVID-19, that the ratio of debt to national income will steadily come down. That's got to be the appropriate target. And that was actually introduced as a feature of the fiscal program in the budget last year. So I think we're going in the right direction. But everything will hinge on the ability of politicians to resist the temptation to throw more money at something when it's attractive to do so. When COVID-19 came along, it was the right thing to do to throw money at it. When other pet projects come along, that may not be such a good idea.
One of the things that we now have, of course, both here and in the US, is rising inflation. And the Consumer Prices Index, CPI, standing at 5.5% in January and heading northwards. How should the bank handle this, and what should it do about interest rates?
Well, I don't like to comment on what my successors have done, but I think the main advice I would give is I wouldn't start from here. This is a very difficult situation that they've got into. what I find most interesting about it is that this isn't just a question of the Bank of England. Every major central bank has, I think, made the same mistake during COVID, which is to decide to do a lot of QE, which effectively means printing a great deal of money electronically, without actually having a good reason for doing so. So I think this reflects an intellectual error stemming from the academic world in many ways, in which people thought, well, thinking about inflation in terms of money is a bit old hat. You know, that's what people used to do in the 50s and 60s. And we're sort of more modern than that. So we've got these very fancy models in which the only thing we look at are just interest rates. And we've been through a period in which inflation was pretty low. But central banks, when they started to do QE, did so in order to prevent the amount of money in the economy held by the public, so-called broad measures of money, from falling. So in 2009, after the banking crisis had ended, the main challenge for the Bank of England and the Fed and other central banks was to stop the amount of money in the economy from declining. That would have threatened a repeat of the Great Depression. So central banks did print money electronically through QE, and in so doing, they ensured the amount of money in the economy didn't fall seriously, so we didn't get a repetition of the Great Depression. But the reason for doing that was because the banking system at that point was not lending, it was contracting its balance sheet. And if you contract a balance sheet, since the only iron law of economics is double entry bookkeeping, if a bank stops extending loans to the scale that it was doing and lends less, that means the amount of deposits, which are its main liability, also contract. That leads to a recession or even a depression. That was the situation in 2009. But the situation in 2020 was totally different. What happened in 2020 was that the banks weren't contracting their balance sheets. And by printing a great deal of money through QE, central banks actually led to a very rapid expansion of the amount of money in the economy. In the case of the Federal Reserve, money was growing faster than at any point since the Second World War. Now that's an extraordinary situation. Now that doesn't guarantee mechanically that you get inflation, but what it does do is to flash warning signs, but nobody asked the question, what is this telling us? What should we infer from this? And part of it, I think, was that central banks had got used to an intellectual exercise in which they were setting monetary policy in their models, not in the world. And this is a terrible mistake. You know, models can be useful or not useful, but you should always ask the question, you know, what's going on here? What's happening in the economy? And when COVID-19 hit, what is so apparent is that this was totally different from a normal business cycle. In a normal business cycle, businesses, households lose confidence. They stop spending, so aggregate demand and GDP fall. But potential supply doesn't. The ability of the economy to produce hasn't changed. So you have monetary stimulus, whether you print more money or cut rates, and that encourages people to spend today, and you gradually close the gap between demand and supply. And once you've done that, then you can remove the monetary stimulus and off you go again. But 2020, there was certainly a very big fall in GDP, 20% in Britain. But actually supply fell equally by around 20%. It wasn't the case that supply was unchanged. The economy was shut down. Large parts of it were shut down. And what you can see right through 2020-21 is that you have both demand and supply falling together, then they rose again together, and they fell again over the next winter, and are now recovering again together. But at no stage could you say there's a massive gap between demand and supply, a so-called output gap, that would justify monetary stimulus to stimulate demand to close the gap. And what we've now got is that central banks, without really understanding what they were doing, I think, have managed to create a monetary overhang. It's a one-off. It was a monetary overhang just in 2020 and 21. It's not going on now. In that sense, the impetus to inflation is transitory. But it's transitory in terms of a number of years, not in terms of a few months. And I think what we've learned from all this is that if you ask what's going on in terms of inflation, the old description of inflation arises when there's too much money chasing too few goods is quite a good way of capturing what's going on. And around the world, we're seeing now all the major central banks struggling with the fact that they had kept interest rates too low during 2021 and printed too much money. So now they're trying to adjust, and they face an immensely difficult problem because on the one hand, it's clear that rates are far too low relative to where they should have been to prevent the rise in inflation. But at the same time, if they raise them too quickly, or if they do it too slowly and then keep going for too long, then the risk is that at some point they will tip the economy into a downturn. But I suspect the right thing to do now is to, do something noteworthy so that people say, they realized that there was a mistake and they're on the case. The idea that somehow that just a few interest rate increases a year and a few more the next year are going to do the trick, I think is not realistic, and they'll be continually trying to catch up to where they ought to be.
Now, Mervyn, over the course of the last few years, in this country, we've had not only the pandemic, but also Brexit. And I think you recently co-authored a book entitled Radical Uncertainty.
Yep.
Both the pandemic and Brexit impose radical uncertainty on us. How does a bank, how does a government plan for a period of uncertainty?
So let me start by saying what I think went wrong in the campaigns during Brexit and went wrong in the early stages of the pandemic. Both sides of the campaign during the referendum in 2016 were very keen to come up with precise predictions about the consequences of voting either to leave or to stay. And at one point, I think George Osborne and the Treasury put out something saying that every family will be £4,300 worse off a year if we were to leave the EU. And of course, the Leave campaign said that we'd have, was it £350 million a week for the NHS if we were to leave. Now, both of these numbers were totally misleading. And in many ways, the worst mistake was that of the government because they had more credibility to lose. And I was struck by the number of people, 2016, I was promoting an earlier book, and I went round and I didn't talk about Brexit at all, but in questions, people would say, where can we find a statement of the arguments for and against? They had lost trust in both sides of the campaign. And when George Osborne revealed that figure of £4,300 a year, then I think people basically said, well, he can't possibly know. He cannot know that. This is propaganda. And it irritated them because people felt they were being talked down to. Instead of being given a statement which said, look, there are arguments on both sides. There's a good deal of uncertainty. My judgment is that we would benefit more by staying in than leaving, or the other way around. A reasoned argument. What you just got was a categorical statement that it was obvious that any sensible person would vote either one way or the other. And I think people lost confidence and trust in both sides of the campaign, but it particularly damaged the government, I think. When we got to COVID-19, I was very struck at how the epidemiologists made exactly the same mistake as economists. That is, they wanted to forecast what was going to happen, the number of cases, the number of deaths. And what they should have said was, look, we're epidemiologists. We understand the nature of an epidemic. We can tell you that it starts very slowly, and by the time you realize there's an epidemic, actually it's spread quite a long way. Then it accelerates very quickly, then it tails off, and there are various ways in which it can come to an end. Now, we can't make predictions now because we don't know key things about this particular virus, such as the length of time it takes between contact and infection and developing symptoms, the mortality rate, and so on. And they made indeed precise predictions, just as economists make predictions about GDP growth and inflation over the next 2 years. They give you a single number. Economists say the economy is going to grow at 3.2% with 5.3% inflation, and the epidemiologists said there are going to be so many 100,000 cases. All of these things simply damage the credibility of so-called experts. Experts should not be judged by their ability to predict in an uncertain world. What they can do is to say, these are the things we should try and find out more about. So in the case of COVID, I do think that one of the mistakes was that if the epidemiologists had said, look, we don't know the mortality rate from this virus. We can see how many people are dying from it, but we have no idea how many people are currently infected. So why don't we start a random survey of the population on a big enough scale that we'll be able to find out how many people are currently infected. That would have given us information that would have been very helpful in understanding the scale of what was going on and potential demands on the NHS. So it's not that experts are useless at all, far from it. It's just they get sucked into exaggerating what they can say. And I think, I don't know what your experience has been, but mine was that one of the questions that going to parliamentary committees, for example, sometimes people would ask me questions and I'd say, I don't know. And they'd be shocked. And what do you mean you don't know? It's your job to know. And I'd say, no, it's not. I can't know something that no one else can know. With great respect, you can't know either, I'd say to the MPs. And I think good public policy has to recognise what we know and what we don't know. And I think one of the mistakes of economics is to pretend that either we know everything or we know nothing. And actually, we do know something. And one of the tricks in handling a situation is to ask the question, okay, so what's going on here? What is actually happening? And the stories that Michael Lewis talked about in his book on the pandemic in California, where some of the health officials who were most successful basically just started by looking and saying, what is happening here? What's going on? And I think, therefore, working out what information we need to collect, trying to understand what's going on, and most important of all, recognizing that we've got to make a whole range of systems, from not just the financial system, but the healthcare system, energy supply, the way businesses operate. We've got to focus less on pure efficiency and profitability and much more on resilience and robustness. There is no point being super efficient and profitable if something happens and you fail completely. That's what happened to the financial system in 2008 with the financial crisis. Everyone had said, this is one of the most successful industries in Britain, highly profitable, terrific. We should boast about it. But actually, it turned out they were lacking in any resilience because they had not issued enough equity to be able to absorb losses when something went wrong. And they didn't have enough liquid assets to be able to replace short-term funding when that disappeared. And so basically they were on the brink of collapse. I mean, all the major financial institutions would have failed had it not been for government intervention. That is not a good, you don't have to wait until disaster hits before realizing that you need a more resilient and robust system. So I think there are approaches to problems which come out of recognizing that uncertainty cannot just be tamed or measured in terms of known probabilities. If we don't know something, we don't know it, and we should be open about it. There's a very revealing case where Barack Obama, when confronted with the decision about whether to send the Navy SEALs into the compound in Abbottabad. And the question was, is the man in the compound Osama bin Laden or not? Yes or no? And the CIA, after the intelligence failures in Iraq, were instructed to give the president advice in the terms of probabilities. So Barack Obama asked people in the Situation Room, so is this man Osama bin Laden or not? And one guy said 90% it's Osama bin Laden. Someone else said 50%, 80%, 40%, 60%. And afterwards, Barack Obama gave an interview where he said these probabilities were confusing the situation rather than helping. The fact was, we didn't know. But what he wanted to know, why are you confident that it's bin Laden? And why are you not confident that it's bin Laden? That's that kind of helpful conversation to have. Not pretend there's some number which sort of answers the question.
For what it's worth, I think you're not only right about economics, but you're also right about politics. The culture of politics nowadays does not encourage someone saying, I don't know. And we ought to be better at saying, I don't know. And this is what we do know. And here are the arguments for and against what we might now do as a result of that partial knowledge, but we don't know the whole picture.
Well, I remember when I was growing up, the speeches of backbenchers were always published in the newspapers. So when you had a proper debate in Parliament, when people would stand up and make a speech which was designed for an audience in Parliament who knew that we didn't know everything, you got very high quality speeches pointing out different views and different perspectives on an issue, and that helped a much healthier debate. Now we seem to have a tribal approach in which there are two groups of people who are much worse than football supporters, attacking each other on both sides of the aisle, as it were, and there's never any room for nuance in the debate.
Yeah.
And that's a terrible loss, because most issues that matter are ones where nuance is important and where you want to hear an argument developed and where you want to say to someone, okay, so I hear that's what you want to do, but can you say again why you want to do that? What is it that leads you to think that?
Now, one of the impacts of the pandemic has been to increase inequality rather dramatically. And that is set to get worse with the cost of living increasing quite rapidly. Is there anything that central banks, policymakers can do to ensure that the economic effects of the pandemic are borne more fairly across society?
I don't think there's very much that central banks can do about it. And indeed, I think that it's a mistake for central banks to pretend to be able to influence things that they can't have much impact on. So they have a very narrow mandate, or should have a very narrow mandate, of controlling inflation. They have a limited set of policy instruments to do it. And those instruments do not allow them to take measures that would help people who seem to be treated more harshly than others. And there is no doubt that high inflation typically damages people on low incomes more than those on higher incomes. But that's where the government comes in. The government has sort of given to the central bank the tools and the mandate to control inflation. The government then needs to use its tax and spending policy to try to ensure that the consequences of all this are that we don't see an undesirable rise in inequality. I think it's important to discriminate between inequality of wages and inequality of wealth. Inequality of wages has been affected primarily by changes in technology, globalization. These are the two big factors. And there's not much that governments can do quickly to offset that. This has been building up for a long while. I do think that an obvious area that governments on both sides have been trying to focus on is how to help the 50% of the population that don't have the privilege of being at a university and give them training opportunities, and recognizing that there are many skills that are highly valued that actually do not require a university education to acquire. That's one area of policy that can certainly work. On inequality of incomes. On inequality of wealth, there is no doubt that a long period of very low interest rates has pushed up asset prices. And if you happen to be lucky enough to own assets, particularly financial assets, your wealth has gone up a lot. And if you don't own them, then you're still as poor as you were. And that's led to a rise in wealth inequality. That will, I think, naturally unwind as interest rates go up. And as we get back to a more normal level of interest rates, whatever that is, then I would expect wealth inequality as measured to fall back.
Now, you mentioned earlier on some key differences between the financial crisis of 2008 and the position that we now find ourselves in as we emerge from the pandemic. Well, as we hope we emerge from the pandemic. Are there any similarities? Are there any lessons we could have learned from 2008 that we should be thinking about now?
I think there's one very big lesson, which was after the financial crisis, we realized that the banking system before the crisis simply was not resilient enough. So we put in place measures to make it more resilient. They had to issue more equity. They had to hold more highly liquid assets, particularly in the form of deposits with the Bank of England. This was a big lesson, and it was learnt in respect of the banking system. The interesting thing is that no one really said, you know what, maybe this question of resilience applies to everything else. Our electricity system, our health system, businesses. So you can see after COVID now that businesses are rethinking their strategies for supply chains. It's not enough just to say, we'll buy wherever it's cheapest, if that supply chain can be cut off. And I think we've seen that ease of movement of not just people but goods across borders is no longer something that you can guarantee will run as smoothly as it did in the past. So people are looking now to backup chains, where can we get things at home? Even when it came to, say, producing vaccines or PPE equipment, many of the advanced countries now want to make sure they have domestic manufacturing capacity, not to rely on buying it from overseas. These will bring about, I think, quite significant changes in the structure of our economies. But it's something that we shouldn't have had to wait until COVID hit in order to realize the importance of resilience.
So does this mean the world is de-globalizing?
I don't think it's de-globalizing in a serious way. I don't think there's a real threat to the idea that free trade is something from which everyone can benefit. I do think that people will be much more cautious in the short run about creating new free trade agreements, partly because the big mistake that was made was to rely on the economic argument. We know that free trade means that as a whole the country is better off, and that means that in theory we could compensate the losers from the winners. Of course, we didn't actually do that. There were a lot of losers. And I think people are going to be very cautious now about taking steps without thinking through how they're going to help the potential losers in the future. So I think that the whole speed of opening up will be drastically slowed. But I don't think the era of free trade is going to go drastically into reverse, no.
And a final question for me before we throw things open to the floor. You spoke earlier on about the Treasury having to draw back from quite so much spending. What's going to happen in terms of austerity in the next 5 to 10 years? Are we heading back into an age of austerity?
So I don't like the word austerity, because whether a degree of fiscal consolidation should be described as austerity or not, I think depends on the context in which it's introduced. So in the context of the European Monetary Union, if you simply have more budget tightening and nothing else is happening, then I think you could describe that as austerity. But in 2010, when there was fiscal consolidation in the UK, there had been other things changing quite dramatically. In the period from the onset of the financial crisis through to the beginning of 2010, the sterling exchange rate fell by 25%, biggest fall since the Second World War in such a short period. And that was going to lead, it was expected, to a significant boost in external demand to offset the reduction in internal demand resulting from budget tightening. Now, in the event, since the European economy did not recover anywhere near as quickly as was expected, the impact of the exchange rate on external demand was a lot smaller than was expected. But equally, because of the automatic stabilizers, when the economy grew more slowly than was hoped, the degree of extra, there was more spending in terms of unemployment benefit, and there was less consolidation of the public finances because tax receipts actually didn't rise as fast as was expected. And I think, therefore, to use the word austerity in that context is not, I don't think, either realistic or actually very helpful. The big question looking forward for the next 5 years is to go back to what I said before, which is I do think that somehow or another we're going to have to get used to the idea that governments can't just throw out money as they have been doing. They've got to be very careful in their priorities, and that we will need to be on a path under which the ratio of national debt to national income declines slowly but steadily, so that we will be in a good position again when the next pandemic or war or some other major event comes along.
Thank you, Mervyn. I've hogged you enough, I think. So I'm going to now pass over to Juliana Kozak-Rogo, who is going to moderate the questions from the floor and from online. Juliana.
Thank you. Hello, my name is Juliana Kozak-Rogo, and I'm a member of the Senior Faculty in Management Practice and also Director of the MPhil in Management at CJBS. It is such a pleasure to be hosting this Q&A session with you.
So you'll ask just gentle questions then?
Just gentle questions. So this is the time for the audience to come in. And during the interview, we had some questions coming in, but to remind the online audience that you can continue to submit your questions, let us know your name and if you are connected to the University of Cambridge. And for the ones joining us in the lecture theatre, feel free to raise your hand and we'll bring the microphone over to you so you can ask a question directly to Marvin. Yes.
Okay, my question is about the free trade and the economic sanction, because nowadays some countries imposing some economic sanction to the others, but it seems doesn't change their policy at all. So this kind of hurting people's behavior and doesn't change their behavior at all. Why we still have some economic sanction, and what is the economic sanction can be regarded as the kind of the nuclear war scale of economic sanction? Yeah, that's it.
Well, the question of whether economic sanctions work or not depends very much on circumstances. Economic sanctions in respect of South Africa did have some effect. But if, of course, the people whom you are sanctioning are prepared to accept a significant reduction in either oil supplies or their standard of living, then the sanctions won't really change the behavior which led you to impose the sanctions in the first place. I don't think one should put the phrases free trade and economic sanctions together. Free trade is a policy, an approach to how we manage the global economy, which is meant to be for a long number of years. It's not something you introduce and then stop. Economic sanctions are something that you don't really intend to apply for too long a period, but you hope what it will do is to make the other side realize that their behavior is unacceptable to the countries imposing the sanctions and will alter their behavior in the dimension that you wish it to go. So that does depend very much indeed on the other side and how much pain they're willing to accept. So I don't think it's easy to generalize in that respect. Whereas I think with free trade, you can generalize and say that this is an era into which the world moved, which was regarded as immensely successful. The number of people in poverty in the world declined sharply, but there were losers. And the mistake was that we didn't think enough about the losers from more free trade and globalization than we should have. And if we'd done that, then I suspect we wouldn't have seen some of the political feedback that we've seen in elections in the West in recent years.
Thank you, Mervyn. We have one question from the Zoom audience referring to emerging markets. So you discussed UK and US COVID strategy, unemployment and inflation consequences. So the question is curious to understand what will be the concerns in emerging markets. So I will add to that. So I'm from Brazil and I know inflation there is quite high, almost 11%. If somehow we are trying to achieve a soft landing in advanced economies, does that imply a hard landing for emerging markets necessarily?
No, I don't think it does, but I think that there's one special problem which both emerging markets and low-income developing countries face, which is the scale of the debt that they have incurred, particularly in foreign currencies, US dollars primarily, and how that's going to be handled. Because I think the impact of COVID-19 has drastically worsened the fiscal position of many countries outside the industrialized world, both the large emerging economies like Brazil, but also the 80-odd low-income economies that the IMF have written about. And the reason why this is problematic, I think, is twofold. The first is that we've never really had a period in which we were considering restructuring the debt of so many countries at the same time. We know through the IMF that it's possible to restructure debt, but it's not easy, it can take time. But to try and do it for so many countries at the same time is going to be problematic. So there is a question there as to what the G7 and the G20 countries can do to put in place a framework to speed this up. The second problem, which is distinct, is that in the old days, when you had to restructure the debt, either of an emerging economy or of a low-income country, what you would do is to bring together the creditors of those countries and bring them into a room and try and get them to agree that it was in their collective interest to restructure the debt. Now, no one creditor is ever going to agree to debt restructuring if the beneficiary is another creditor, as opposed to the borrower country. So you need to bring all the creditors together. And when it was the case of the major banks, then it was possible to do that. Now, however, the problem is that there are three groups of people who are the creditors now. You've got the big banks still, you've got the Western governments, and most significantly, you've got China. Because much of the lending to low-income countries in the last 10 years has come from Chinese state banks. And I think it's going to be immensely difficult to get them to agree to take part in a debt restructuring process. We tend to start this process with the Paris Club, where officials of the G7 would sit down and try to bring in the creditors. But even if you brought in the Chinese government, my guess is they would say, well, actually, it's not official debt that's being extended to these lower income economies. It's debt from the state banks. That's not the same thing. Well, pretty much is the same thing. And I think this is going to make the practical challenges of restructuring debt a big problem. And if you were to say to me, what do I think is the biggest challenge facing the world economy in the next 5 years? It would be restructuring of debts, not just of sovereign debts, but actually of businesses around the world, where because we've had a decade of very low interest rates, it was possible for zombie companies to survive, because at a low interest rate, you can just about service the debt, even if there is no prospect of ever repaying the principal of the debt. My guess is that that is going to come to an end, both with interest rates rising and the need to restructure our economies, that zombie companies' their debt will have to be restructured as well. So I think this is going to be a big challenge for the world economy in the next 5 years or so.
Thank you very much. We certainly haven't had that historical experiment. Yes, another question from our audience. Please go ahead.
So Mervyn, thank you for the talk and welcome back to Cambridge. My question is in relation to Brexit. There's no doubt the decision to leave was a questionable one at the time. However, having gone through quite a harsh period of uncertainty right now in a tumultuous negotiating period, sitting where we are today with a deal on the table, if you had the agency to do so, would you have us re-enter the European Union, or do you think there's a pathway to prosperity for the UK?
Well, I would not re-enter, because I think we had a referendum. Everyone was told this is the rule of the game. There are going to be arguments. It was actually a long campaign. People were pretty well informed, I think, based on the arguments that were given. They voted. I think you just can't turn around and say, we don't like the result, we're going to change it. So I wouldn't do that. And there is a path to prosperity. I don't defend the way it was handled after 2016. I think there was a much better way to have handled the result of that decision than actually happened, with no proper preparations being made to enable us to negotiate properly. It would have been possible to have unilaterally announced that all EU citizens in the country at the time would automatically get permanent rights of residence. It was pretty obvious we were going to get that anyway. The idea of saying we're going to bargain this with the rest of Europe was, I think, rather foolish. We would have got the high ground at that point. And we could have entered the educational and research arms of the EU in the way that other countries outside the EU do. There are many things we could have done to demonstrate that this was not a decision that was anti-European in any sense. It was a decision that we didn't want to belong to a political union that took creating a fiscal union for the euro area member countries and a political union very seriously, when actually we didn't. And I think that if David Cameron, maybe in 2016, after the summit meeting, when he tried to negotiate better terms, if he'd said, this is no good, I don't need to hold a referendum this year, I'll do it next year, you've got 12 months to come up with two things. One is to give more control over immigration to each national country, because he wasn't the only country asking for more powers to be given. And my guess is they would have been given over with enough time to discuss that. And secondly, just to say, look, you in the euro area need to have a proper fiscal union, but those countries outside it do not. So don't think the degree of political union has to be the same for everyone. It doesn't. You do need two tiers of membership. And I think, again, if that had there been time to discuss and debate that might have been one as well. But the point I made at the time, and I still stick to, is that I don't see that the changes brought about by Brexit are going in 20, 25 years' time to have a major impact on the level or growth rate of the UK economy. Who knows exactly what will happen, and some sectors will be affected. But I don't think joining the common market, as it then was in the early 70s, transformed the UK economy. The scale of innovation, productivity growth are driven by much deeper factors. And it's not as if we have suddenly introduced massive tariffs on trade. So once things are settled down, my guess is that actually the success or failure of the British economy will depend on our own internal policies. And that doesn't mean that we'll be automatically better off outside the EU. Depends on what we do with it. And that will hinge on a much wider range of factors, clearly not just government policies, but education and so on. So there's no reason why. I mean, I certainly wouldn't want to argue that leaving the EU means that we're going to have a wonderful new future, better than the one we would have had in it, in economic terms. I just don't think in 25 years' time people will look back and say it made a massive difference. In terms of economics, clearly it was very important in terms of politics.
Thank you very much. Thank you for sharing your perspectives in these challenging times we find ourselves. We have one more question from an economics student at Pembroke, Matthew Cresswell, and he's asking about independence of the Bank of England, which was consolidated in the 90s, and has this independence been challenged somehow? Could we say perhaps that by resorting very frequently to these more unconventional monetary policies through purchasing of corporate bonds of various sorts and funding schemes and backstopping of the financial markets and non-banking financial institutions, what does that imply for central bank independence in your view, Mervyn?
So I think there are two dimensions to this. One is formal or legal independence. I don't think there is any threat to that, and I think it would be a very brave government that decided to pass legislation to remove independence from the Bank of England. They would see an adverse reaction in the markets. But the much more interesting dimension is the other one, which is a sort of de facto independence. And I remember back in the 1990s when we created the inflation target, put it in place, the Bank of England had a more important role in giving public advice about what should happen to interest rates. And that, of course, the first act of the new Labour government of 1997 was to give the Bank of England full independence in respect of the setting of interest rates. That turned out to be a very successful move in my view. It was interesting that when it happened, the Conservative government immediately, Conservative opposition as it then was, immediately opposed it. Still back to what we said before. Now, what they now say in private is they're all in favour of it, of course, but they had to say they were opposed to it because they were the opposition. But they came round, and I can tell you in the next decade, there was not a single instance where the government tried to lean on the Bank of England to set interest rates at some level rather than another. Not one. Now, why was that? I think it's because at the time, the atmosphere was one in which people did still remember the 1970s, when inflation went to 27% in the middle of 1975. They remembered the 1980s when inflation had started to come down but then took off again in the second half of the decade. And there was general support right across the country, across politics, for an independent central bank that would control inflation. I think the situation is very different now. First, because inflation has gone up to levels that we haven't seen for a very long time. Second, because the central banks around the world have not produced a convincing or credible narrative to explain either why they were doing a good deal of QE and what its effect would be, and now why inflation has in fact risen. And thirdly, because I do think that central banks have gone too far in trying to extend their mandate. It's almost as if they've taken the view, if there's any bad news to hit the economy, then we have to do more QE. And it doesn't matter what kind of bad news it is, you know, COVID. I'm surprised we didn't get it when England lost the euro finally. But you know, the idea that we should always do something to offset bad news is very damaging. And sometimes it's the right thing to do more QE. Sometimes it isn't. It depends on circumstances. But once you start to get into doing things like buying corporate bonds, then essentially you are making decisions about how much risk taxpayers should be taking. And that's not for the central bank to do. It would be much easier if the government feels that it wants, if the government feels that there's a good national reason for buying the bonds of particular companies or industries, it should be the government that decides which bonds to buy, and it can issue government bonds, which the central bank can then buy, releasing the money to enable the government to then go ahead. And that's the way there ought to be a very clear division of responsibilities. And deciding on the allocation of credit within the economy doesn't make much sense. And I'll give you an example. When I went to Parliament, and I was pressed on this because I said publicly that I didn't think we should do very much by way of corporate bonds. There was one period of market dysfunction where we did a very small amount to narrow the spread between the buy and the sell price. But other than that, we didn't do it. And the MPs pressed me on it and said, but it'd be very helpful to small businesses if you would buy their equity or their bonds. I said, well, I'm sure it would, but that's not the role of a central bank. And they said, well, surely if it helps the economy, it'd be a very good idea. So why won't you do it? And I said, well, okay, if you insist, I can think of a fairly small company in the Midlands. And if we were to buy their bonds or their equity, I'm absolutely convinced that consumer confidence would rise sharply and the economy would pick up. And they said, well, fantastic, why haven't you done it? And I said, well, actually, I would quite like to spend something modest, only £1 billion, on buying the bonds issued by Aston Villa Football Club. And they said, you can't do that, you can't do that. And I said, well, you've made the point for me. It's not for me to decide which company bonds to buy. And I think central banks have extended their mandate into thinking they were doing the right thing for the country. They've chosen to extend their mandate into areas which ought to be the purview of elected politicians. And once you start to do that, then I think you run the risk that politicians will understandably say, well, if you're involved in all that lot, we need to be involved as well. And then you lose the clear separation of the different responsibilities. And that's when de facto independence comes under great pressure, either because pressure is brought to bear on the governor or deputy governors or members of the committee, or because of the appointments that get made.
Absolutely. Thank you very much. We have one more question from the audience. Yes.
So I'd like to ask about how did you deal with U.S., especially Federal Reserve? So you said sometimes U.S. central bankers make wrong decision, and in that case, U.S. have stronger influence over global economy. So when U.S. doing some wrong thing, how do you deal with, or how do you project U.S. politician and economic leaders?
Well, I think if you believe the US is making a mistake, you don't follow them. That's the obvious thing to do. And I do think the problems we've seen in the last few years have not come about from the central banks themselves. It's come about through a faulty intellectual analysis, really coming out of academic life about the right way to think about monetary policy. Believing that the model is the world. That's the real problem. Models can be very useful, but they don't apply to every problem. They're not a description of the world. And if you start to believe that your model is the world, then that's where mistakes start to be made. But I'll give you an example of the opposite, which is an example of cooperation between central banks, which illustrates why central banks are special. After 9/11, when the terrible havoc wreaked on the United States, meant that the New York Federal Reserve basically had to leave their building. They couldn't do any of the operations they would normally have done. I was in Paris for an OECD meeting, got back to London, and what we discovered was that the UK banks that would normally, on a regular daily basis, borrow from the Federal Reserve in dollars to meet their payments and then repay it the next day, could not do so because the New York Fed wasn't functioning. So at that point, Alan Greenspan, who was chairman of the Fed, was stuck in Europe. He tried to fly out, the plane had to turn back. So he was out of action, basically. So his deputy, Roger Ferguson, was in charge. And Roger, of course, is at Pembroke College now. I telephoned Roger because I was deputy governor, he was vice chair of the Fed. And I said to him, look, we'd like to do a swap. We'll swap you sterling for dollars. And then after a few weeks, when things are settled down, we'll reverse the swap. And we did agree a swap of $30 billion, which was quite a lot of money in those days. And we could then lend the dollars to the UK banks to overcome the problem until the New York Fed could get up and running again. And to me, what was so striking about it was the reason why Roger and I could do that was because I knew him as Roger and he knew me as Mervyn. We worked closely together on many international fora, and we met every other month in Basel, and we trusted each other. That's what central banks can do. It was fascinating at international meetings. When you look around the table, most of the people from finance ministries had changed from the previous meeting because the finance minister had been sacked or whatever. But the central bankers were the same. So there is a community of spirit and trust that builds up. And once you trust people, you can do things. And that conversation Roger and I had, not a single lawyer was present in that conversation at all, not one. That, I think, is testament to what trust actually means. When you can swap $30 billion for sterling and agree to reverse it a few weeks later, simply on the basis of personal trust.
Well, thank you very much, Mervyn, for sharing your knowledge with us. I will now pass us back to Mauro for concluding remarks.
Okay, thank you so much. I think since we are at a business school, we have to end with 3 takeaways. Okay, that's what we always do in business school classes, right? So for me, the 3 takeaways, the first is that there's a fundamental difference between 2008 and 2020, and it has to do with the supply curve, right? So let's not forget that, and that depending on the circumstances, then QE may be more or less of a useful tool to use. Second takeaway, efficiency versus resilience. Banks need to be resilient, the financial system, the banking system needs to be resilient. But now we're finding the hard way that supply chains and also the labor force needs to be resilient. And the pandemic has put a lot of pressure on those two. Third takeaway, emerging markets, that is potentially the problem, the role of China in all of that, and that we're going to have to go through restructuring, both of corporate and national debt. And actually, for me, that's good news for a business school. We're going to need a lot of managers out there, people who understand finance for all of that restructuring, wouldn't we? So when I started as dean 6 months ago, I said in this same room, you've never joined a business school at a better time, because I think the world needs a lot of managers, needs a lot of people who can understand all of these issues. A couple more things is first, don't go away. Those of you who are here in the room, join us for refreshments in the Simon Saintbury Center. And if you come, you'll be able to chat with our 2 guests here today. I should also remind you, there was a Federal Reserve chairman, right, in the 50s and the 60s, who said that the job of the central bank is to take the punch away when the party is getting interesting. So I promise you that today we won't take the wine or the beer away from you, okay, during the party. So please join us, Simon Saintbury Center. And lastly, please join me with a very strong round of applause, thanking both Lord Chris Smith and Lord King. Mervyn, you make us proud of being at Cambridge, because this is your home, this is your alma mater. And thank you so much for sharing with us your experience and your wisdom here today. Thank you.
Thank you.